Hello and welcome to the Raise Capital Legally podcast and YouTube channel, your go-to source for insights on raising capital the right way. We dive into topics that matter most to real estate syndicators and fund managers with live Q&A opportunities before we wrap up. I'm Krisha Young, your co-host, business development director, and client success coach at Syndication Attorneys. And joining me is attorney Mola Bosland, one of our esteemed senior securities attorneys at Syndication Attorneys. Now, before we get started, please note that audio and video from this event will be posted on our podcast platform, YouTube channel, website, and social media, and will be made available to the public. You can go ahead and ask questions at the end of the broadcast by raising your hand or typing it in the Q&A. And please note that information discussed during this event is of a general educational nature and should not be construed as legal advice. So today we've got from small deals to serious scale, what's really working in multifamily right now. In this episode, attorney Mola Bosland and Krisha Young sit down with Greg Donahue to unpack what's actually happening in the multifamily market after the post-COVID slowdown and what operators should be paying attention to now. Greg shares how pricing has reset, where deals are finally penciling again, and why smaller operators with strong local partnerships may be better positioned than ever. They dive into Greg's strategy of focusing on 5 to 25 unit properties in New England while scaling into larger assets in other markets, the importance of true boots on the ground asset management, and why many sponsors underestimate what it takes to operate well over a full hold period. The conversation also explores investor return expectations, preferred returns, split structures, and why chasing headline returns can backfire in today's environment. Hello, Mola. Hello, Gregory. How are you?
Hello,
Hello,
Krisha.
hello.
Hello. Well, I'm very excited to be here today, and I'm really happy to get to talk to you, Greg, since we talk, normally when it's about deals. So now it's more background information.
Yeah.
So since I already know you, how about we
Yeah.
let the audience get to know you a little bit better? So why don't you tell us a little bit about yourself and your real estate investing company?
Yeah, awesome. Thank you, Krisha and Mola. Great to get on this podcast with both of you. I'm Greg Donahue. My company's 21 George Investors. I am in Boston, Massachusetts. Big Boston sports fan. Looking forward to the Pats game this weekend, back in the playoffs. Started investing in real estate back in 2014. I had no prior real estate experience. My dad actually nudged me into joining a real estate, multifamily, educational program, and had no real estate experience before that. Hadn't even bought, a single family home, nothing. So really just used that educational program and networking group as my foundation to start this real estate company. We started by buying small multifamily properties in secondary cities throughout New England, mainly between 5 and 25 units. And since then, we've expanded through partnerships in other parts of the country to get into larger 100 plus unit deals and syndications.
Wow.
Nice.
Yeah.
It's always good to watch people scale up, so I know that your team, focuses on 5 to 25 units in the New England area, and then the larger assets, elsewhere. Why that split? What changes operationally as you move up in the unit count?
Yeah, I would say we started with the 5 to 25 unit properties in New England because that's what we were comfortable with. Again, being from Greater Boston, a lot of these programs coach you to go for the, 200 unit properties in Texas. I had never bought a property before, and I also had never been to Texas. So how am I going to do that? So it was just the natural starting point was, something I'm comfortable with, something I can drive and check out personally. I don't need to buy a plane ticket. So just started by acquiring, a 5 unit property about 15 minutes away from where I lived at the time, again, back in 2014. And started scaling up there. And we kind of created our business model around the 5 to 25 units throughout New England. And we're, fairly successful at doing that. But as we grew and the market matured, we started to get priced out of the market a little bit. The deals weren't penciling quite as much. So we decided to expand into other markets across the country with boots on the ground partners in those markets. And then naturally, as you have a partner, you can kind of go after bigger deals as well. So that's what kind of got us into the larger deals in the other markets.
Awesome. Okay, so well, you did mention boots on the ground, right?
Yeah.
And so, what breaks first when the operators try to manage properties that are remotely, like without having a strong local partner?
Yeah, I mean, I think, you implement the third party management company. And again, I had no real experience, with real estate before joining an educational program. You're kind of, my understanding was, oh, you put the third party management company in place and you're all set. You're pretty much a passive investor. But I learned pretty quickly that is not the case. Um, so we bought some properties outside of New England, and we really had issues with our third party management company. Here I am flying down to Alabama, once a quarter, multiple times a quarter, sometimes staying in, a sketchy Motel 6 for 2 weeks at a time to oversee, the property management company, try and get them right back on track. Next thing you know, you're firing a management company, bringing the next one in. So after that experience, we kind of realized if we're going to be investing outside of New England, meanwhile, we were having a lot of success with our New England properties because we're here. I can jump in my car, drive by the property, make sure everything's going well. So we kind of built that into our model rather than focusing on the market. I mean, we still obviously do our homework on the market, but really emphasizing the co-GP boots on the ground partner first in building that strong relationship and strong partnership first, so that when you do have those operational issues at your property, you have someone in that market that knows what they're doing that can be there, driving distance away. So that's kind of why we really implemented that into our business model.
Mhm.
Okay. Well, how about you give us a little insight on, structuring those relationships with the co-GPs and the local operating partners, especially those markets outside of your area?
Yeah, so I mean, we definitely try and partner, or I mean, first and foremost, it comes down to building a strong relationship over time, not just meeting someone once at a conference and jumping into a deal with them, building a relationship over time, making sure you have shared values, you can trust them, you communicate well with them. Um, but it's also finding someone with a complementary skill set. I'm definitely strong with financials, underwriting, bookkeeping, reviewing ongoing financials on the asset management side, working with the accountant, making sure we're hitting our KPIs from a financial perspective. So when we're partnering with somebody, we're looking for someone with more of a good, construction management background or renovation who can drive by the property, make sure the units are getting renovated correctly, make sure the CapEx projects are going well, and just having those clear roles. So when you jump into a partnership like that, you understand who's doing what. Hopefully, that's everyone's role is within their strength, and just kind of outlining those roles so everyone's in a good position to succeed within the partnership.
And I like how you said that, right? I talk about that with our clients all the time that are talking about partnering with other people. You need to find partners that are strong in the areas that you are not strong, right? You guys, that
Exactly.
comes
Yeah.
together and brings together a good working relationship.
Yeah.
It's understanding your own strengths, your own weaknesses, what you're looking for in a partner, things like that. So, it's
Yeah.
really good to hear you say that's how, you've put together your structures with other,
Yeah.
co-GPs in the area, you know.
Yeah.
Um, well, I know like many sponsors do focus heavily on, the acquisition part and the raising capital, that's all everybody ever really focuses on.
Yeah.
But, what happens about the asset management? Like, why do you think
Yeah.
it's still so underappreciated in this business?
I just think it's not as fun to talk about. No one really likes to do it or really wants to do it, but it's such a huge part of this business. And I think a lot of the people that succeed over time are the ones that really focus on the asset management and oversight of the property and implement systems where they can continue to scale. Um, and that's not to say, I mean, we work with third party management companies on all our properties, but we still utilize that boots on the ground partner to kind of oversee them because we've had good, bad, ugly experiences with property management companies. So you just have to be prepared for everything. And I think everyone wants to talk about the acquisition side, finding the deal, closing on the deal, you know, celebrating after you close the deal. I mean, that's kind of the fun part, talking about, renovating units and, dealing with a maintenance issue. Like that's not fun to talk about, right? But it's a huge part of the industry of the business. So, it's something you really need to focus on and spend time on.
Well, isn't that where the
That's
money's been made? That's where the money's being
right.
made, right?
Right.
Exactly.
The
Is it
Yeah.
tenants are
just
who's
that?
paying the
I
money,
mean, the
right?
whole
Yeah.
point of it is
Well,
to like make money.
yeah. The cliche is, the money's made when when you buy the deal, saying like, oh, we're getting such a great deal, that's when you're making all the money. But I mean, that's, I guess, partially true in a way, but you still have to operate it for three,
Mhm,
5, 7, 10, 10, however long your hold period is, and you
mhm,
still have to execute your business plan. So,
Right.
mhm.
um, it's, the money's not just made when you buy the property; it's made throughout the operations as well.
Yeah.
Very, very true, right? Because how do you get tenants to want to come back if the building becomes shabby and nobody's cleaning it and no one's taking care of
Yeah,
it? Who's going to want to pay rent to live there, right?
exactly.
So
Yeah,
that's a major portion of
yeah,
it for people to still want to live there.
yeah, exactly,
But also,
100%.
like when you're syndicating, you've got investors. Like
Mhm.
there's payments that are continuing throughout the
Right.
Yeah,
duration of
yeah,
the fund that are
yeah,
reliant on this part being done well.
Right.
yeah, exactly,
Yeah.
and
No
just
tenants,
ongoing
no
stuff.
money.
Exactly.
Exactly. Yeah, yeah. I mean, a huge part of real estate is the cash flow distributions, and a lot of reason why people want to invest with you is because of the cash flow. And if you're not operating the property well, even if you get lucky and you hit the market at the right time and you buy and low and the market appreciates like we saw, a few years ago and everyone it was making a ton of money. Um, but that still doesn't solve for the cash flow issue. You still need to operate the property well to give those cash flow distributions. And it's very rare to hit the cycle like that where you're just gonna make money no matter what you do. So, but you definitely don't want that to be your business plan. Timing a market is not a business plan. That's just luck in a lot of ways. So.
Hmm.
Yeah. you know we've helped you with quite a few of your deals, and we know that you typically target like a 5 to 7 year hold,
Mhm.
with a 7% preferred return and about a 70-30 split. How are investors expectations are evolving around this current market?
Yeah, I mean, I think they're definitely, I think, more open to longer term holds, or that's something we're trying to uh, push out there a little bit more. Is, I mean, we've always kind of done the 5 to 7 year hold, where I think a lot of people typically wanted the 3 to 5, nothing longer than 5 years. I think investors are starting to become more open to the slightly longer term holds. And investor expectations, I mean, I think, to be honest, I think they've kind of stayed the same. I think, the 7-8% preferred return is still pretty market, and um, just making sure you're hitting those returns and giving those cash flow distributions. So.
Okay.
Hmm.
Let's see. So, we've talked about the investor expectations, the longer thresholds. What are you most interested in exploring going forward, and why?
Um, yeah, I mean, I think just continuing to do what we're doing and get more consistent at it, hopefully see the deal flow pick up a little bit more. Prior to 2020, 2023, 2024, we didn't really see much activity on the acquisition front. 2025, we had a acquisition, so that was big to kind of get the acquisitions back in motion, and I'm hoping we can kind of continue to grow more in 2026 and moving forward. And Yeah, I mean, I think maybe get into some newer Class B assets. A lot of what we've been doing is Class C, which we're still open to. I know a lot of people are kind of, pushing away from the 1960s, 1970s assets. We're still open to them if the numbers make sense. But it would also be nice to get into some newer assets as well. So yeah, definitely just trying to scale a little bit more, a few more acquisitions moving forward, and maybe get into some more Class B assets.
Okay. Okay. Let's see. You know, we kind of field calls all day from people that are interested in starting syndication and learning more about syndication. But we have started to see like a lot of market noise around that 18 to 20%, returns. How do
Yeah.
you balance honest underwriting with competitive investor messaging?
Yeah, I mean that's tough. I mean, because underwriting's so easy to manipulate that you can change one little thing. If your deal's penciling at 16 or 17, and you're like, oh, I need to raise this money, and I need to really get to that 18. It's so easy to manipulate it to get there. But I think it's just sticking to, at the end of the day, you need to build trust with your investors, and it starts up front. And just putting something in front of them that you feel you can achieve, and you're not, like I said, a lot of this, the acquisition part of this deal of this industry is the fun part, finding the deal, closing the deal, but you have to have a longer mindset and in your head that once you close the deal, that's actually just the starting line. That's not the finish line. Once you close the deal, that's essentially the starting line, because you have to operate the deal. So if you're trying to enhance your numbers a little bit to raise all the money, just remember you're going to have to meet those projections once you close on the deal. So I think it's just sticking in building trust with your investors, because you want them to invest with you again. So I think I hate saying I underwrite conservatively, because everyone underwrites conservatively, but just sticking to
Or
your numbers.
should.
Yeah, they should. Yeah, but or they'll tell you. They'll tell you.
Right.
So will I. So I guess I'm just like everyone else. Uh, but yeah, just sticking to your numbers, investing based on your numbers, and building trust with your investors so that they'll continue to invest with you.
Definitely. Like I know that I've had that conversation with, clients and potential clients about their projections and about sometimes their numbers are not realistic, right?
Yeah.
And, I think that when people see like these really grandiose returns, like or
Yeah.
projections,
Hmm.
I think of two people are looking at it two ways. One, the syndicator doesn't know what they're doing. So they're going to be
Yeah.
able to take advantage of that syndicator. Or two, it's a
Yeah.
scam.
Yeah.
So it's either like, oh, you're another Bernie Madoff,
Yeah.
it doesn't look realistic when the returns are just ridiculous. Like I've had somebody come before and they're like, yeah, we have like a 40% return. I'm like,
Hmm.
where?
Yeah.
How?
Yeah.
How? Can you explain that to me? So,
Yeah.
you got to balance that out with investors like expectations and so
Hmm.
I don't feel there's anything wrong with conservative underwriting. Like if they were to get more than what you projected, oh my God, you're amazing,
Yeah.
but as long
Yeah.
as you're realistic in the game and
Hmm.
truthful, people will, more gravitate towards that. That is, what
Yeah.
you know, have
Exactly.
seen from, doing
Hmm.
this for a while.
Yeah.
Um,
Yeah, just to piggyback on that, I feel like investors that are flipping straight to the return section of the pitch deck, like that's not, it starts with the team that you're investing with. How many full cycle deals have they done? Are they a credible team? What's their backstory? What's the story behind the deal too? If you can get a 40% return on a deal, why is that? Which,
right.
you need that backstory on the deal, that history. There's got to be something, special
Oh,
way
that
that you found the deal, or
right. Like,
what's the
how did
story
you? Yeah.
behind it.
How
So
did you come to this conclusion? Like, where did you get these
exactly.
numbers from?
Yeah.
I've asked those questions. I was like, how did you break this down? Because I've had a potential like investor before that got documents that showed a really high number, and it was only in the in the pitch deck. And so they wanted to know, like, where is this stated in the documents? Is this money
Yeah.
guaranteed?
Mhm.
If this is what the returns are, yes, I want to do that. But where are they
Yeah.
in the documents? I didn't see that in the document. And I'm
Yeah.
like, well, they're projections and
Yeah.
assumptions. They're not necessarily like, definitely what you're gonna get. But you might want
Yeah.
to ask some of these questions, and give them a
Yeah.
laundry list.
Yeah.
But
Hmm.
you have a financial background, right? But it's like largely self-taught. And
Yeah.
you just, you didn't start in real estate. Your dad, kind of pushed you in that direction.
Yeah.
But how has that shaped your approach compared
Mhm.
to more traditional sponsors?
Yeah, I mean, I would say, I mean, there's probably a lot of sponsors like us as well, but again, just very numbers driven and not necessarily future focused. We're not going to invest in a deal and say, oh, we think it's going to be all sunshine and roses in 5 years from now. So we're going to drop our exit cap, you know, and that's going to be where we can get to the 20%, return to our investors. We just underwrite everything based on what we're seeing today in the market. And, and yeah, and just using our numbers on that. We're not trying to have aggressive market rent increases over time because I mean really you can't predict what is rent growth going to be in 3 years. Like really no one really knows. You can look at some CoStar reports or whatever's out there to try and come up with an idea, but they're not always right either. So just kind of underwriting based on today's numbers and expectations. And we've probably missed out on a lot of deals. I kick myself, especially like I said, I got started in 2014. I think between 2016, 17, 18, I mean, I definitely missed out on a lot of deals. There's a lot of deals I look at and I'm like, damn, like if we bought all those, maybe wouldn't be doing this right now. Um, but yeah,
Don't
we
do
missed
that
out on
to
a lot of
yourself.
deals, we definitely missed out a lot of deals, but I mean, it's, the price, you got to be conservative. You got to underwrite based on today. You don't know what's going to happen in the future. Just like, the market skyrocketed between, 2016 and, whatever, and the interest, the COVID spike and everything, but you can't
Yeah.
predict it, right? It's probably not going to happen again. And the market can go the other way as well. So pretty much just underwriting based on what you have in front of you and no aggressive, expectations moving forward. So.
Listen, my grandmother always said, what's meant for you is meant for you, right? So
Yeah.
even though you didn't get to jump on that wagon at that time, it may not have
Yeah.
just been meant for you. You don't know what other issues they may have had in the background. They could have made the money, but
Yeah.
they had to probably jump through some hurdles,
Yeah.
Yeah.
but when you're
Coulda, shoulda,
talking,
woulda.
right,
Yeah.
but you were talking about, 16, 17, the numbers, were high. Like, there were
Yeah.
deals out there.
Yeah.
But a lot of the pricing was very unrealistic. Like, and you're
Yeah.
seeing some people pay for that now in this
Yeah.
market, right?
Mhm.
So, how do you think today's buyers' mindset really differ from, what you were seeing maybe 5, 6 years ago?
Yeah, I mean, I think you're seeing, yeah, I mean, I guess it's tough. I mean, I think that post-COVID boom when interest rates dropped, I mean, people are buying everything, throwing ridiculous prices at stuff. I think people have kind of learned from that being more, I think the market's weeded out some people. I think the people are being, less aggressive with their underwriting and predictions moving forward. So I think just more realistic buyers. Um, and now I think the sellers are starting to slowly get a little bit more realistic as well, where, for a little while they still wanted that kind of peak of the market price, but buyers weren't willing to pay for that. So there is a little bit of a stalemate between buyers and sellers. I think we're seeing sellers' expectations become a little bit more realistic. And I think buyers, just need to be patient and, invest in the deals that make sense. And like I kind of mentioned earlier, you're seeing a lot of groups pivot towards, 1990 or newer assets. I think that's changed a bit in the recent years, whereas before people were buying, any property that they thought made sense. So
Definitely. You can see the shift because, right post COVID, everybody was like dashing to get into real estate. I'm
yeah,
an investor. I'm buying this. I'm
hmm
buying that.
yeah,
I mean, it was an influx in the
yeah,
market. There were some really high prices. People were paying
yeah,
whatever just to get their foot in the door.
yeah,
And then in the last like 2 years, you started to watch it like really taper off.
yeah,
There was no meeting of the minds anymore between the sellers and the buyers. Things
yeah,
were just kind of stagnant.
yeah,
The Now you were really picking and choosing what were the best options and what are the best deals to move forward with.
yeah,
So you really started to see that more in the last 2 years,
yeah,
especially with the interest rates had been really high. So
yeah,
it
yeah,
didn't, not every deal made sense. And that is something that we've always talked about with our clients, about the viability of your deal, right? Because
yeah,
it may always sound good, but it might
mhm,
not be good once you get it on paper. And it
yeah,
might not, it might just be a flop.
yeah,
So those are things that we always tell people to look out for and,
yeah,
really to decide how viable is the deal. So
yeah, yeah, definitely.
let's see. So
Mhm.
So you have, scaled up and started
Hmm.
getting involved in larger assets. So
Yeah.
for their operators out there that are looking to scale, from smaller
Mhm.
properties to larger assets, um,
Hmm.
what mistakes do you see most often?
Um, yeah, I mean, I would say the big one is not having, I mean, for us, again, it was not having the boots on the ground partner in some of the first deals we did in other markets and just saying, oh, here's our third party management company. They're going to take over everything. I'm going to go focus on finding the next deal now. So I think, the biggest mistake is not paying enough attention to the asset management and putting your asset management systems in place to manage your properties after you acquire them. Again, I think a lot of this business, especially a lot of the educational groups out there, are all just the fun part, the acquisition part of the business, but don't spend as much time on the asset management. So putting those systems in place to have your third party management team, but oversee them as well and make sure you have your asset management systems in place. And then also uh, you know, another thing I see is that like, we're building at some point your mindset needs to shift from investor to entrepreneur. You're building a business when you're buying. If you're just investing in one deal or just buying one deal, you're an investor. But as soon as you start buying multiple deals and start trying to repeat it, raise more money, buy more deals, manage more deals, you're building a business. So you
Mhm.
have to set up those systems internally to handle all that as you continue to buy properties, continue to underwrite properties. A lot of people will buy one deal and another thing is, they'll buy a deal and get sucked too much into the operations of that property. And now they don't have the opportunity to go buy more properties. So it's kind of like setting up those systems to asset manage and acquire more properties. And Yeah, so I think that's a big one. And also understanding what going big means. You go to a lot of conferences and everyone says go big, meaning buy a 200 unit property, go for the bigger assets. But going big is more on the enterprise level, the business level. Like if you set up your systems where you can consistently buy 24 unit 20 unit property, 50 unit property, 12 unit property, just keep buying them and you have those systems internally. I mean, that's going bigger than just buying one 100 unit property, so it's kind of really understanding that going big is kind of on the business side of this, and it doesn't mean just buy one big property and then you're done. It's setting up the systems to continuously acquire properties.
Mhm.
Definitely. So, see, the mistakes can also just be advice and what not to do, right?
Yeah.
Yeah.
But when you were talking just now, you're talking about, that some people like just bought like, they'll buy one property and then they kind of feel like they're underwater.
Yeah.
So how do you decide when a deal is no longer, making sense to pursue, or even if you've already invested the time and the money into it?
You mean like on the acquisition side? If I'm like we haven't acquired it
How
yet,
about how about both?
both.
Because we're seeing, listen,
Yeah.
we've got you've got people out here in the market that,
Yeah.
learning about deal viability, but then you've also got people in this market now that have
Mhm.
already did the deep dive, and you do have
Yeah.
some assets that are now in default, right? Their
Yeah.
foreclosures are upticking now because of things
Yeah.
that have happened post COVID.
Mhm.
So
Yeah.
what would you do in either situation? Like, how do you just
Either.
make that determination in either situation?
Yeah, I would say it kind of come for me. It kind of comes down to the same thing. I would say on the acquisition side, if we haven't bought a property yet and we're looking at it to buy it, it would be, do we have the team in place in that market to handle this type of project? Say it's a heavy lift. Um, you know, do we have the team in place? Meaning, kind of again, probably the boots on the ground partnership to handle this project, and are we confident we can handle this heavy lift? If we don't have the team in place in the market, then we'll probably just pass on it. But if we do have the team in place, then and we feel like we can handle it and hit our returns and execute our business plan, then it's like, all right, let's go for this. And then of course it's the price. Like if it gets bid up, then obviously there's a point where you just you know you move on from it. But assuming you're getting it for the right price, it's do you have the boots on the ground, or for me, it's do I have the boots on the ground team in that market that can execute this business plan. Um, then if you already own the property and it's you're struggling with it, you're not hitting your projections. Um, I would say, how if it's causing you, if you're not hitting your projections, but it's not causing you too many headaches, meaning you've kind of finally solved the issues and it's slowly moving in the right direction, even though it's not hitting the projections you originally wanted. Maybe you can keep that. Hopefully it works out in the end. But if it's still causing you headaches, it's underperforming, you're spending all your time on it. Probably just at some point you have to move on to it and spend your time looking for another deal.
Okay. I like that advice.
Yeah.
Everything it's all a full cycle, right?
Yeah.
So it's, the work that you put in the beginning, and it's also the work that you put in after. Like you said earlier, closing on the deal is actually just the starting point, right? You have to do all these
Yeah.
other things in the background to keep the deal moving forward, right? And keep the
Yeah.
asset cash flowing,
Mm-hmm.
and making it attractive to the potential tenants, and also that it can bring the cash flow back to the investors because they've already put their
Yeah.
trust in you. So it's all
Mm-hmm.
a, it's all one cycle, whether it's
Yeah.
the beginning or the end. It's all
Mm-hmm.
about how you maintain that throughout the life of the deal, so I
Yeah.
think that's, I like that. It's pretty
Yeah.
interesting. And I like the way that you, made it succinct for everybody.
Yeah.
Let's see. So we know that you've had some of your biggest wins in like the New England area.
Yeah.
What makes that region particularly attractive or challenging right now in the current market?
I would say challenging, just that prices have, it's hard to find new acquisitions in at least the pockets we're looking in New England. So we haven't acquired too much here recently. That's definitely the challenge. What makes it attractive is just the the market as a whole. The occupancy rate is in the high 90s. It's just a very stable market. We don't have any oversupply issues. Population growth isn't, you don't see the population growth here that you see in the Sun Belt, but it's just kind of a steady market. And you don't see the oversupply issues that you see in the Sun Belt either. It's a very steady market. We have, again, for me, it always comes down to the team. We have a great management partner here. And then also, I can drive by our properties as well anytime. So just have a great team in place. We can acquire any deal and fit that into our management systems and we'll be fine. So, just comes down to the team I think that we have here, and then also just kind of a nice steady market with high occupancy, and yeah, so it's just a nice steady market, and we have a good team. So those would probably be the two biggest things. So,
That's good.
Figured it
Like
out.
I live in Florida. So I live in Florida where we
yeah.
have pockets that are completely overpopulated and underhoused.
Yeah.
And then we have areas that have a whole bunch of new construction and not as much
Mhm.
population. So,
Yeah.
you know,
Mhm.
you see the difference, but when you have a balance, I think that makes that market really strong.
Yeah.
So I think that's a
Exactly.
good thing.
Yeah.
But but looking ahead, right, into the next few years,
Mhm.
what do you think successful multifamily operators will be doing differently than the rest of the pack?
Um, Again, probably sound like a broken record, but focus on your operating systems, asset management. I hate making future projections, especially when it comes to like, if you want to go on LinkedIn and see everyone's interest rate projections in, the next few years or what the housing market is going to do, you can just scroll through LinkedIn, get a bunch of predictions.
Mhm.
Again, I don't like to, I try and underwrite based on today's metrics. And I think focusing on your asset management systems, your ability to manage assets, that's what really is going to help you succeed in this business over a long period of time.
I like that. It's realistic. It's a
Yeah.
very realistic and it's a practical thought
Mm-hmm.
and method with regards to, managing these properties. Asset management and boots
Mm-hmm.
on the ground is extremely important and it affects
Mm-hmm.
every part of the deal, right?
Yeah.
From acquisition to the life
Mm-hmm.
of the deal to even closing on the deal, like to sell it.
Yeah. Yeah.
So, because if it's not taken care of, then you're not going to meet your projections on what you hoped it would even sell for,
Yeah.
right at the end.
Yeah.
So, all of that is just the integral part of how much asset management and boots on the ground really matters from beginning to end for the
Yeah.
life cycle of the deal. Whether it's 3 to 5, 5 to 7,
Mm-hmm.
indefinite, it doesn't matter. It's still
Yeah.
like an integral part of helping achieve all of your goals. So,
Yeah. And I think it's just control what you can control, and uh, what is it? What's the saying? Forget about what you can't control or whatever. But you can't control what rent growth is going to be in 3 years from now, or what interest rates are going to be in 3 to 5 years. Whenever you exit, your exit timeline is. You can't really control that, but you can control putting the right team in place, getting the right people to partner with.
Mm-hmm.
Overseeing the asset, making sure you're executing your business plan. So that's what you can control. So that's where your effort, should be going.
Mm-hmm.
mhm.
I like everything that you're saying here, and I like how your emphasis on like the entrepreneurship part of it.
Mm-hmm.
Like
Yeah.
it's a business at the end of the
Mm-hmm.
day,
Yeah.
and
Mm-hmm.
having those systems in place really
Mm-hmm.
has allowed you to sort of like rinse and repeat and realize some success in these assets because you've got something quite stable there within your own
Mm-hmm.
company that
Yeah.
and you're not like kind of cowboying it out like going for that
Mm-hmm.
big massive unit or whatnot like you've
Yeah.
started with like some steady
Mm-hmm.
like asset types and then like grew like are growing from there
Right.
and it
Yeah.
seems maybe a little more boring but it's not
Mm-hmm.
because you're being
Mm-hmm.
successful and success is
Yeah.
Right.
is great it's fun that's
Mm-hmm.
what we want at the end
Yeah.
of the day
Yeah.
how
Yeah.
Yeah.
many
It's
syndicates have
definitely
you done?
um good amount. I don't know.
Mm,
I would say maybe close to 10-ish.
Wow, that's amazing.
somewhere. Yeah.
Yeah.
See, that's
Uh,
huge.
Yeah.
yeah. It's gone well. I mean, it's definitely a longer, definitely didn't I think some people kind of grow quicker um, than maybe I have, but it's just been, I guess, slow and steady, and hopefully to keep growing. So
Mhm.
that's that's the plan. But yeah, it was definitely a realization on my end too. Like I didn't realize, when you start buying properties, you're just like, oh, I'm investing in real estate or whatever. But then over time, you kind of realize like, oh no, I'm I need to start implementing some systems to handle all this. And you kind of realize like, you're building a business, not just,
Mm-hmm.
Yep.
managing a couple properties. So.
Yep, you become a full-fledged business owner, entrepreneur. And
Yeah.
I like that mindset, right? Because a lot of people just come in and it's like, oh, I invest in real estate. And then they never get past that mindset because that's all they've been like thinking of, right? When you see
Yeah.
big flashy, oh, I have, 500 million assets under management, right? And that's all
Yeah.
everybody like is projecting for them. But then, so they're like, oh, I want to be like that. But they don't
Yeah.
think about how hard it was to get to that
Yeah.
point. So that's why
Yeah.
they always think, oh, big, I need 100 units, 200 units. Oh, I'm not
Yeah.
investing in anything smaller than that. And I've had
Yeah.
people say that to me before.
Yeah.
And they're like, well, I don't think the property is big enough to syndicate. And I'd always be like, you can syndicate anything,
Yeah.
right?
Yeah.
It doesn't necessarily mean that it has to be 100 units. We have clients that syndicate,
Yeah.
quads.
Yeah.
Depending on where you live, a quad can be a couple $1,000,000, right? Like
Yeah.
if people
True.
lives in
Yeah.
California, right?
Yeah.
Yeah.
That's very expensive,
Yeah.
right?
Yeah.
So I was like, it's based on like you have to look at the market that you're planning to invest in, and the experience that you want to gain from it. I go,
Yeah.
it's not just a deep dive. I go because with each syndication you learn something new, right?
Exactly. Yeah.
And you can speak from experience. You
Yeah.
Yeah.
learn something new with each different one that you've done.
Yeah. Yeah, definitely. And especially if it's your first deal and you say it's too small to syndicate, like the size of the deal doesn't matter. It's like, do you have the money or not? If you have the money and you can pay for it, then you don't need to syndicate. But if you don't have the money, then you have to syndicate it. So the size of the deal, and then if it's your first deal, it's just a good experience anyways, just learn how to syndicate the deal and learn how it's done. So, yeah, the size of the deal shouldn't matter.
Well,
Yep.
while we're on this, Tolise actually has this question, and we're kind of answering it right now. How do you know if your deal qualifies to be a good candidate for syndication? Is there a minimum number of units? I'm fairly new to investing and have a lot of opportunities come my way. So I think we've answered this question in a way.
Right.
It's
It's
like,
not really
do you
about
need,
the units.
yeah, do
Yeah.
you need the
Yeah.
money?
Right. Do
Yeah.
you need the money? Can
Yeah,
you
exactly. Yeah.
close this deal out of pocket? And a lot of times what happens is that people that, yeah, they can close it with their own money, but at some point they're going to reach a cap where they're now, they have no liquidity, right? So they have to start to keep growing. They're going to end up needing to syndicate at some point in time,
Yeah.
because your own taking that on financially on your own after a while, just it's going to hit a cap.
Yeah.
And some people do have the liquidity to be able to buy it on their own, but they want the experience of learning how to syndicate. And so they look at the potential growth in the future, right? So they want the
Yeah.
experience no matter how small the deal is. We've had people that have come to us to syndicate to raise $250,000. That's all they needed.
Yeah.
Right. It was all about for those people getting the experience and learning the behind the scenes and how to manage other people's money. That is a big thing when it comes to syndication, and people don't understand that. It's like, yes, you have a real estate track record, but it's more than your real estate track record that builds the confidence and the trust of investors. They want to know how well do you manage other people's money,
Yeah.
right? Are you just going to throw it away and then, the project's a flop? No, they
Yeah.
want to be able to see that steady growth, that track record of how you manage other people's money. So
Yeah,
people will bring in small deals for it.
Exactly.
Yeah, that's a great point. Again, just kind of building your business rather than just investing in one deal. Like the syndication is a system that you need to learn how to do it, go through that process. So as you continue to buy more, you kind of have that system in place, and then as you have more investors, there's a investor communication, system that you have to implement, monthly or quarterly newsletter, property updates to your investors. So you have to have, if you're just buying properties by yourself, you don't need to send any updates out, obviously, because you're the only investor. But as soon as you have investors, it's about keeping them updated on a monthly or quarterly basis, providing them reports. Filing your tax return becomes a little bit more difficult, getting the K-1s out on time. So those are all more, once you start accepting investors, those are all systems you have to implement into your business to, stay on top of, throughout the whole period.
Yeah.
Yeah.
What I like. We've done so many of these podcasts and interviewed a lot of people, and the thing that I keep hearing over and over and over again is like that communication with investors is like
Hmm.
so key. It's so
Hmm.
key. It's the make or
Yeah.
break kind of thing, like if you're
Hmm.
not communicating with your investors, then like you're
Hmm.
leaving them wondering what's going on, and even when if
Yeah.
something's not going well or if things are going really, really well, it's
Yeah.
having that like really um, solid communication with
Yeah.
your investors. Gives you a good reputation, and
Hmm.
then if things do go a little sideways, they're there to support you. They're not going to be
Yeah.
like, "How come you didn't tell me about this?" It builds that
Mhm.
trust that you were talking about.
Yeah, I would say investor communication is just below returns on what investors are looking for. Obviously, returns are number one, but just
Right.
below that, people don't understand how important communication is and how much investors appreciate that. So yeah, definitely, communication is huge, and you need to, uh, you know, stay consistent with those, investor updates once you acquire a property and start accepting investors into your deal. So.
Hmm. Hmm.
Yep.
Talise said, "Are you able to syndicate non-multifamily properties?" Yeah, you can syndicate pretty much anything.
Anything. So the
Anything.
legal definition of syndication is actually the pooling of funds for a particular purpose, right? So the purpose is to purchase real estate. We have clients that buy land and get it entitled and then flip the land. They syndicate for that. We have people that do office buildings, development, your home developments, whole developments, RV parks, mobile home parks. We have a whole series that we've done in a few of these podcasts on syndicating beyond multifamily. So if you would like to go to our podcast page and also go to our website, syndicationattorneys.com, you can find out more information on syndicating beyond multifamily.
Hmm. And businesses too.
Yeah.
Yeah,
Yes.
we're seeing more business customers come through as well.
Yes.
Yeah, I'll put
So
that.
do we have any other questions out here for Greg?
I don't see any in the chat or anything or Q&A. Does anybody, how about our attendees? Are there any questions here? Like I was hearing, I always hear like the steps, when I'm listening to our guests and like what is the secret to success here? And what I heard is like you started with this coaching program, and
Yeah.
that's definitely something that we as a company encourage our clients to be involved in some sort of coaching program, right? Because it really
Hmm.
helps you understand the market. It helps you understand
Yeah.
underwriting. It puts reality
Hmm.
in most of the programs. It puts reality. Some of the programs are a little unrealistic, but um, and so and then you started local and small.
Yeah.
Like it
Hmm.
was like, well, we're here and this makes more sense to me. And I just
Yeah.
want to see if I can do this thing, and
Yeah.
this,
Hmm.
and and then that boots on the ground part,
Hmm.
was really important and something that you
Yeah.
would not have, I mean, you would have learned it the hard way if you had gone
Yeah.
out of state, I
Hmm.
guess. And so you learned
Yeah.
it sort of like the easy way to be like, okay, yeah, it's really good
Yeah.
having somebody like local
Hmm.
here,
Yeah.
to be able to like property manage.
Yeah.
And then you mentioned like if you are going out of state, co-GPing, so forming
Yeah.
those partnerships, is really
Yeah.
important.
Hmm.
Um, and just building over time, right? Like, and I love that you said values, um,
Hmm.
and building trust and, playing to your strengths.
Yeah.
Those are all like core business 101, I think.
Yeah. Yeah. I mean, and again, going back to the educational program, I mean, I think a big part of our growth was through our partnerships, and all of them have been through, the educational programs are great for the content they put out, but also you're part of a community and a networking group. So that's where you meet a lot of people to help, grow the business. So,
Yeah.
so that's another good reason to join one of those programs.
Yeah, exactly. Like ours, like our
Yeah.
mastermind.
And it's always helpful to be able to meet people that are going through the same thing that you are, right? And learning at the
Yeah.
same time you are. I think that's why so many people get so much value out of our own masterminds, right? Because there are people that are in all different stages. Some people have syndicated for years, some are just starting out, but there's someone has always been where you were at some point.
Yeah.
And,
Yeah.
they're open to answer any questions that you may have, or just have a one-on-one just to, find out, how did it go for them? So
Yeah.
Mm-hmm.
those communities are great learning tools and a
Mhm.
support system.
Mm-hmm.
Mhm. Yeah.
Yeah, for sure.
Definitely.
For sure. Do you have anything else you want to share with us, Greg?
Yeah.
I think we covered a lot of it. I mean, appreciate you guys having me on. I trying to think. I mean, yeah, I would say, I mean, just I think it's definitely a long term, real estate's a long term game. I think, setting up those systems to continue to grow and acquire more, properties is, over time is huge, and not just trying to make it big on one deal and not really have that expectation. I think is very important, and really just kind of, setting up your systems to grow over time. But yeah, I mean, I think yeah, you guys had some great questions, so I think we covered most of it. So I really appreciate it.
That's awesome.
That's awesome.
Can people reach out to you if they have any questions or they want to connect with you
Um,
about any of your deals, maybe? I don't know if
yeah,
I
definitely. What is,
will.
should I throw it in the chat or just say it
Sure.
out? Or
Yeah.
Sure.
Yep. Either I can type it out.
You
Okay.
can throw it out there in the chat.
Okay.
The name. Oh,
Oh,
looks
wait,
like
maybe I
there
have
is a
a question.
question.
How do you find investors to be part of a syndication? Oh, that's a big
Right.
topic for another
Yeah.
podcast. We
Yeah.
we do a lot of training on that in our mastermind. Yeah, so we have a private clients only mastermind. Talise, if you would like to learn more about that, you can reach out to me, and there's a page on our website that talks about it. But we meet every week, and we've got some great free bonus resources in there for people to help you. Um, Establish relationships with investors is more how we would word it than find investors. It's like
Right.
establishing those relationships and doing it legally. Um, so, we talk a lot about it in there. There's a lot of ways to go about that. Greg, do you have any tips on that?
Yeah. I mean, it's definitely, I guess for me, I'm more introverted. I started this business out of college. Most of my friends couldn't pay off their bar tab at the end of the weekend, never mind invest in a real estate deal. So I had like no network. So I just started joining the educational program, going to networking events. That was huge for me to kind of get out there and just find, a few people who were liked what I was doing to invest in deals. So the educational programs was a big one. And then just friends and family. You never know who's interested. You might just mention to somebody who you don't think has any interest in real estate or investing, and they might call you back, later and say, hey, let me know when your next deal is. So just kind of tell everyone about it. Local RIAs or meetups. I know a lot of RIAs are more single family, kind of fix and flip based, but again, you don't know, who you're going to meet. So just really, again, for me, the big one was definitely the educational program community I joined. But there's other resources out there, other local networking events, pretty much anywhere in the country, at least any major city. And
Mhm.
then just friends and family as well. So
Mhm.
But yeah, it's definitely, some people might, if you've had a long career in another industry and you're extroverted and like sales and talking to people, the money raising part is easy for you. But if you're more introverted, you don't quite have the network, then it's a little bit tough. That's not to say you can't do it. Um, but you might want to meet someone who's more salesy,
Mhm.
and develop a
Yeah,
relationship and partnership. So
that's what we
That
say.
is,
Find
yep,
yourself
yeah,
an extrovert.
yep.
yeah,
And that's where the partnerships come in, right? Where we were
Yeah.
talking
yeah,
about it earlier. It's not
Mhm.
just with like co-GPs, it's some people build that out with their management team, right? If you know what your weaknesses are and your strengths are, and their
mhm,
weaknesses and strengths are the opposite of yours, you may just make a really good team and you find somebody that
yeah,
likes to talk to people. And there are
yeah,
lots of them out there. They love to talk to
mhm,
people, chit chat.
Yeah,
yeah,
yeah, for
Yeah.
sure. I'm just gonna read out the information here. So we've got G Donahue, HUE, at 21georgeinvestors.com. And LinkedIn, Greg Donahue, Instagram, 21 George Investors. That's where you can find
that's so
Greg.
fine.
And then I put my email address in there as well, Krisha, Krisha, at syndicationattorneys.com. You can come through me and I can connect you to whatever you need in our team, in our company.
Okay.
Yeah. Oh, and www.21georgeinvestors.com. George Investor, 21 George Investors. Like, that's a unique name.
Yeah, so it's a street name in Lowell, Massachusetts, where I grew up. I don't know if anyone's from Massachusetts on here, but grew up in Lowell, Massachusetts, and my grandfather owned an office building in downtown Lowell, which was not uh, economically thriving. If you know Lowell, Massachusetts, especially in the 80s and 90s, it was not a place where you really wanted to own a downtown office building. But he owned it, and it was on 21 George Street, Lowell, Massachusetts. And my dad managed it for a while, and then they eventually sold it, but we kept the name as 21 George Investors. So that's where we got the company name from. So it's a little family, value to it, I guess.
Yeah.
And now I get confused all the time because my name's Greg and
Yeah.
the company's George, so I get called George a lot. So
I know. It was twisting in my mind too. I was like, wait, what? It's
yeah,
Greg, right?
yeah,
But I love that. That's like a sweet little homage to your
yeah,
grandfather and
yeah,
the original, the OG investor.
yeah, yeah, exactly. So,
Oh, let's see. Let's see. Anybody else have any questions?
I don't see anything else in here. Well, we're almost at time anyway.
Yeah.
Um, yeah. I think we've
awesome.
covered a lot here today.
Yeah.
Yeah, like if I were to conduct a podcast, and it would be like we would cover these main points. Um, yeah, thank you so much. And well, if anybody wants to learn more about what we do, we're syndication attorneys and we prepare offering documents for people who are looking to raise capital in real estate or business. We've got a team of really amazing, super tenured securities attorneys on our team. We've got a great back office team as well to support each other. I'm on the team doing business development, and yeah, we just love our clients and we love the entrepreneurial mindset and everything that goes along with this. And we really love to partner with our clients. So we're not just some document mill that comes in and, whatever. We really want to partner with you and really want to understand your deal and really want to help you become successful and help you understand what everything is involved in raising capital in this way. And we love having fun. We've got our mastermind community and we meet every week and we've got like some really great questions and conversations that happen on there. And yeah, we've been around the block for quite a while. We've got two best-selling books, this podcast, and yeah, a great website with lots and lots and lots of resources.
If you need a referral, I've worked with them multiple times and they do a great job, great to work with. So definitely highly recommend them.
Thank you.
Thank you.
Wonderful. All right, Greg. Thank you, Mola. Thank
Awesome.
you, everybody who's been here for your questions and all of that. And yeah, we'll see you on the next episode.
All right.
Thanks
All
for
right.
having me.
Bye.
Bye for now.
Appreciate it.
Thanks.
Bye.
Bye.
Thanks.